Jerome Powell has spoken, and as soon as he was done speaking, the market went way south. So why did that happen? What did Jerome Powell say? What didn't he say? We're going to start with the national news, the regular basic financial news. We'll get down to Tesla in a few minutes because right now, what Jerome Powell says is probably the biggest thing on everybody's mind. So this is Randy Kirk. If you like this kind of content, if you like this Wednesday show where we talk about both Tesla, the news that's happened so far this week, as well as the financial news and how that might be impacting Tesla, then hit the like button, hit subscribe, hit notify. Tomorrow morning, I'm doing a really important show. You don't want to miss it. So hit subscribe and notify to remind you to see that show tomorrow morning. And I'll mention it a little more in detail later. And then finally, we would love to have more folks join the Patreon. Okay, let's get right into it. So what did Powell say? Well, the thing that caused the market to go up a little bit in the beginning of the statements was, it's not locked in that we're going to have another 25 basis point raise or that we will continue to raise into the future. That's no longer locked in. And then he made it very clear by saying, look, we took out this statement about those future raises, and that was important. We did it on purpose. You should pay attention to it. Well, the markets really like that. But what they don't like is uncertainty, because then he put in, oh, we're just going to decide meeting by meeting based on what's happening with inflation, what's happening with the economy, what's happening with other things that we take into consideration. The data that's coming in will decide at each meeting, meaning nobody knows what they're going to do next time or the next time or the next time. There's no forward information at all. Well, what do markets like the best of anything? Uncertainty. Well, there's where we are. Okay, number two thing that he said, not likely to reduce interest rates this year. The market didn't like that. That was close to the end of the call, and the market tanked. Okay, so the markets had expected one more raise, or maybe not, but they definitely expected up to, and maybe more than, 2 decreases in the interest rates by the end of the year. Those 2 decreases in interest rates were supposed to be stimulative toward the end of the year, giving rise to a wonderful new economy in 2024. Well, those are now off the table, and there was kind of a hawkish like, no, that's just never going to happen sound to it. And so the market was crushed. All right, there's your reason. Sometimes the pundits know, sometimes they don't. I think in this case, it was really obvious. Okay, number 3, what did he say specifically about where the economy is right now? He said inflation is still bad. It's still, right around 4 to 4.6%. That is way more than double with the 2% that the Fed would like to stay under. And so therefore, they're still hawkish in that regard. They want to drive it down to 2. They're not interested in staying at 4.6, and they're certainly not interested in going back up again. He said the economy is still good. He said the numbers, 1.1% in the first quarter is not great, but it's not negative. And every evidence that maybe that's not going to be the same in the second quarter. It might actually start ticking back up above that 1.1% rate. I don't have a good call on that right now, but a couple of things that you're going to see in my further comments might cause you to think that he's right, that the economy might actually start perking back up again. The jobs situation is fine. 3.5% unemployment, historically low. I mean, it's almost as low as it can go because there's always transitioning people quitting, people being fired, and then they go find another job. Well, right now, there's still lots and lots of jobs for them to get to. Yes, there's fewer jobs available right now than there was the last couple of months or the last year, the last 2 years, but guess what? It's still historically outrageous. It's still, I think, on the order of 6 jobs available for every 1 person looking for work. And it's historically, it could be 1 for 1. It could even go the other way. So it's really, the job situation is very strong. He suggested in his remarks that maybe it was getting better, that there was more of a balance in terms of available jobs out there. And I would say that the folks that I talk to, the people that I consult with, the people that are my friends and associates who own their own businesses, I would say there's not as much tension about not being able to find an employee right now. I wouldn't say that means it's easy to find good employees, but there's not as much pressure right now on that subject. Okay, number 4, let's be real. if the idea that this is the top on interest rates results in more economic activity and results in new inflationary data showing that it's either flat or going up, they will definitely raise again. Let's be real. We got to be real. If everybody relaxes and goes, oh, okay, we're gonna have a pause. Let's go ahead and buy that equipment. I mean, we can't stop people from doing that. And I wouldn't recommend anybody who thinks they have a business opportunity, I wouldn't recommend going and buying that equipment. But if that's what happens, if the world and if the United States gets back in gear and says, oh, okay, it's all good now, let's go do it. And these inflationary pieces start to show up again, the Fed will raise again. There's no doubt about that. Okay. On the other side, number 5, people will quickly get adapted to these rates. It's not the first time we've seen 5% interest rates on 6% interest rates on housing mortgages. That's the average over history. Historically, 5.5%, 6% is fine. We've seen 8%, 9%, 10% on mortgages, and people were still buying homes. We've seen 11% rates on new car loans. People continue to buy cars. Yes, it has an impact, but not as much of an impact as you think because people adapt. They find ways to solve it because they have to have transportation. The old car has to be chucked. The new car has to be purchased. You can't not live in a house. You have to have a house to live in. Your rent goes too high. You've got the money in the bank for a down payment. You go find a lovely home. You'll pay the extra on the mortgage. It's just the way it is. What isn't going to change is that there are millions of people sitting there with 2 and 2.5 and 3% loans on their houses who are never going to move unless they're forced to. So that's going to continue to create tremendous problem with availability on the market of homes that are good homes that are available for sale, and that is going to continue to cause prices to go up. Well, that's number 6 on the list. Is housing is strong. There's 30% fewer listings than last year. I'm hearing from my real estate people that there are multiple listings, multiple offers being made on good properties, and prices are inching up. Reporting from some of the national reporting agencies is showing exactly the same thing. So it's going to be a strong housing season from now until the end of summer. We'll see what happens in the fall and winter next year. Number 7, interest rates aren't everything. The other thing that Powell said, lending availability could become the issue. I've studied recessions. If those of you who follow me know I've written a book on recessions. I've studied it backwards, forwards, and inside out. And I will tell you that the worst recessions are the recessions where the cash dries up. So if the cash stops flowing, if there's not enough money, retailers can't pay the wholesalers can't pay the manufacturers can't pay their suppliers of raw materials. Everybody, all the cash is gone, and nobody can do business. I've been through recessions like that. It is the worst. It's actually, to me, as a business owner, worse than the 2008 housing recession. So watch out for a drying up of the ability to borrow money from some of these regional banks that are under stress. Jamie Dimon says the banking crisis is over. Other regional banks are fine, but the market's not treating it that way. Pacific West Bank got slammed yesterday, 25% down on their stock. I didn't look today to see whether there's any recovery on that, but the market still believes that there could be some additional players out there that might have some kind of difficulty. Auto sales are doing well. That's another reported this week. I told you to watch out for those reports this week on auto sales. Auto sales are doing better than expected. Ford suggested they're doing better than expected. They gave good guidance. General Motors gave good guidance. Tesla, of course, is going to sell more cars in the United States this year than they did last year. So all in all, looks like a good year for automotive, even in the face of these higher interest rates. Like I said, the manufacturers will adjust, the dealers will adjust, the lenders will adjust, and the consumers will adjust. Everybody will adjust because I think there's still a lot of pent-up demand for these cars because of the shortages over the last couple of years where people were having to go out and pay massive amounts of money for used cars Well, that pent up demand is now going to the new cars because they can, because they're available, because there's no longer a chip shortage or this shortage or that shortage. People can buy the new car that they want. And so there's a demand correction taking place, which those don't usually just last a month or a couple of months. So we should look out for that. The next one on the list here. Okay, I'm sorry, I already did it. 10-year bonds were slammed today. They've been slammed all week. The 10-year bond was inching up towards being over 4%. It's back down now to like 3.35. Yeah. So what does that mean? That means that still there's this flight of cash to safety. So the flight to safety is still creating a problem. A problem if you want to call it a problem, but basically people are still taking their money, probably out of equities. They could be taking them out of shorter bonds. They could be taking them out of banks, but they're taking their money and they're putting it into these long bonds. And that's driving the interest rates down. So I mentioned this almost every time I do these financial videos, and it's not investment advice. The reason this is happening is because you can get 3.5, 3.3% on your money right now, guaranteed, and as close as a guarantee as you're ever going to get. And when actual interest rates start falling again, it could be a year, it could be 2 years, but these are 10-year bonds. When those interest rates start falling again, all of a sudden your underlying bond value is going to go up. It's going to go up dramatically. So this is it could be a very good play. It's not investment advice. I'm not an investment advisor. Okay. So oil got crushed. So oil was sitting there around $70 a barrel. The Saudis didn't like that. OPEC didn't like that. So they dropped their production by 1 million barrels, 1 million barrels per day. This is, I forget, maybe 3 or 4 weeks ago, and oil shot up to $80 a barrel. Well, guess what? It's back down under 70 again. The last 2 days, it's just been crushed. Generally speaking, that means that the folks that play oil think that there's going to be a recession. It could be worldwide, it could be regional, it could be just the United States, but for whatever reason, the oil folks are saying, you know what? They're not going to sell as much oil. We need to back away. So that's a really interesting thing that's taking place. And of course, it's really good in terms of bringing down inflation. All right, let's switch to Tesla news. Okay, so number one, I was just on Brighter with Herbert, and we talked a lot about some of these issues. I want to talk a little more in detail right now. Tesla is offering 10-year loans, special loan rates, and also incentives in various markets. And most of these markets are really tiny markets. They're not offering them in the United States. They're not offering them in China. They're not offering them even in Australia. They're not in all of Europe. They're offering them, in Tanzania. No, I'm kidding. So, but they're offering them these smaller markets. Why you do that as a marketer? Come on, I'm waiting for the crowd. Put it in the comments below. Tell me before I say it. You do it as a test. You're trying to see which demand levers work. If I offer a 10-year loan at 2% or 3.6 or whatever, but I have a 30% down payment, will that drive up demand? If I have a 5-year loan at 2%, will that drive up demand? So you have all these methodologies that I talk about in the Elon Musk mission. Have you bought your copy of the Elon Musk mission yet? And how come? What are you waiting for? 7 months ago, I'm talking about these demand levers. I'm talking about 10-year leases. I'm talking about paying down loans. So a manufacturer of automobiles has a number of ways they can play these loans, okay? They can go to a third party, a bank or another lender, and they can say, look, we'll give you 1,000 or we'll give you 500 or we'll give you some amount of money to construct a loan of this type. Yes, we know that normally interest rates right now are 7 on a car. We want them to be 2 for a 6-year period. How much would we have to give you to pay down that loan? Now, that might be more or less than $1,000 discount on the car or a $500 discount, but whatever the number is, Tesla can decide, well, okay, let's try that. Let's see what that does to demand. They can also do these themselves. They've already said that they have all the setup ready to go and they're already doing it. They do car loans and they do car leases. I did an entire video a couple of months ago talking about the amazing amount of money Tesla makes when they do a 3-year lease with no ability to buy the car at the end, because they make the money during the lease and then they turn around and sell it at an amazingly good return on their investment. So that's a really good deal for them. Well, I'm suggesting they could do a 10-year lease the same way. I suggest that they could even maybe do unusual leases, like maybe the first year it's a $600 and then it goes to $550. And then maybe by the 10th year, it's down to $500 or $400. But you could play around with these leases because they're the ones creating the lease. So you could try all kinds of experiments like that. Loans, usually you're not going to play those kind of games with the loans, but they do it with the leases. Tesla earlier this year had a lease on a Model 3. I should have looked this up before the show. I think it was $249 for a Model 3, and then they raised it back up to $299. Now, maybe I've got it wrong, and it was $349 and $399, but whichever it was, that's super low, right? So these are the kind of things you can experiment around with and see how they play out. They can also create a situation where they create the loan themselves or the lease themselves, and they can then turn around and package these loans or leases and sell them to a third-party bank. They also, every one of those leases and every one of those loans is also an asset on their books. They can choose to keep those assets if they like the return, if they feel the return is better than they can get on their $22 billion that's just sitting around. Maybe they think that's a fine return on that asset. But if they think they could do better with that money, they can turn around and borrow money against those assets. They can bundle them and, et cetera, et cetera. So there's all kinds of ways. I am sorry about all the dinging, but a very good friend of mine is sending me a whole bunch of tweets and I don't have any way to stop it. Anyway, so, all right. So the Tesla price increase, new subject, the Tesla price increase the other day was pure genius. I did a whole video about that yesterday or the day before, and the stock market really liked it. This was evidence that they're not going to continue to lower prices. This was evidence that they've got enough sales in the house in order to not need to lower prices anymore. This was evidence that they are psychologically astute and wanted to send a signal to at least consumers and potentially to the competitors that they're no longer going to be reducing prices by any significant amount. I don't think it was a signal to the market. But consumers in particular needed to be signaled, no, you're not going to just be able to wait around for another $1,000 or $2,000 or $3,000 discount. We're kind of done now, and you better get dialing or going on the web and putting in that order because the price might go up another $500 tomorrow. So this is all psychologically extremely genius, totally the right kind of marketing. More evidence that these guys know what they're doing. In addition, they've added more product. I can tell you as a marketer, I was in a seasonal business. Every single year, we would add brand new product in our off season when things were really at the very, very worst. Every year, we always lined it up so that we were offering brand new, great product so that we could fill up the pipeline in our off season. We had fewer sales of everything else, throw in a new product, build up the total revenues for those months when we weren't doing it so well. Well, guess what Tesla just did? They just followed my advice. I sent them this advice the other day. I'm kidding. They added another variant to the Model 3. It was a variant that fits really nicely into a place where there was no sticker that was about that amount. So it's you want to have them at like 30,000 and 35 and 37, 40, 42, et cetera. So they've done this. They've filled another one of these gaps with a really good vehicle at very good value. So that might have also affected the market the last couple of days because Tesla has outperformed yesterday and today. I think it was these two marketing moves that actually caused Tesla to outperform these last 2 days. There was nothing else. There's nothing else that was happening. They might have been responding a little bit to GM and Ford's utter failure to get their EVs to market. I'm doing an entire video on this tomorrow. This is the one I've got for tomorrow morning that you want to hit notify so that you're reminded to look at it. I don't quite understand why Ford and GM are not able to get the market with their EVs. It's really becoming kind of concerning. I'll talk about that tomorrow. All right. Next news item. Tesla ended production of mega chargers in Sparks, Nevada. Now that is going to free up some space for them to start making semis. This has been the missing link. This has been the thing I couldn't figure out. Elon said, we're going to make 40,000 semis in Sparks next year, 2024. He didn't say 2025. He didn't say maybe 40,000. He didn't say we're hoping to make 40,000. He said, we're going to make 40,000 semis in Sparks, Nevada next year. And then here we are into May, and they're not even shipping, a few hundred a month out of their pilot line. And people are starting to go, what's going on with the semi? People are forgetting about the semi. People are forgetting about the amazing backlog they have of semi orders, about the amazing profit they can make on semis, which I've spent hours and hours of videos. You can go back and look at them. They're still all totally up to date, 100% as useful today as they were when we created them. It's a huge potential business for them. So what are they going to do? Oh, what are they going to do with that space? Okay. Get all that equipment out of the way, start putting in the semi line. I thought up until now, I thought, gee, they're going to have to put the walls up, put the roof on before they can start building that line. In the expansion, they're doing an expansion at Sparks. I thought, gee, they'll have to get that expansion done before they can build the line. So how are they going to do 40,000? Here's the explanation. I'm saying by May 3rd, by May 15th, they will have all that equipment out of there. They will be starting to load in the new equipment for the semi line. And we will see our 40,000 in 2025 rather, that will just be one more thing. That'll add $1 per share in earnings in 2024. How do I get there? 40,000 vehicles at 350,000 each at 25% margin. I think it'll be way higher than 25%. I think they may sell them for more than 350,000. All that put together is 3.4 billion in profit added to 2024. That's $1 a share. That $1 a share plus energy at another $3 a share. That's $4 a share. That's $4 a share added to what I think is going to be at least $8 a share from auto. So they're going to be looking at $12+ per share in 2024. Take it to the bank. No, I'm not an investment advisor. Okay. So that's what's happening with semi. Final piece of news for today is the FSD for Europe was sped up by the Eurozone authorities by an entire year. They were supposed to have FSD approved by 2025. Now it looks like they're going to be approving it by January of 2024. That's kind of an estimate right now. I think it could happen a lot faster than that if FSD was ready to go. They haven't felt any urgency to get it done because FSD wasn't complete. Well, do you think that they sped it up without some kind of information from Tesla, without somebody from Tesla walking in and saying, here's where we are, here's what we think is going to happen. You're going to need to speed this up because otherwise you're not going to be able to have this product when it's ready to go. You think that they just, one day they woke up and they go, we should speed up this process. Anyway, I don't think so. What do you think? Put it in the comments below. Listen, that's it for today. I know it went long, but there was a lot of stuff to talk about today. Remember to watch that video tomorrow morning. Remember to like, subscribe, hit the notify, and then join Patreon. I've had a little bit of a period now, I think like 7 days with nobody joining Patreon. I really do need more income from Patreon in order to make this worth it. This is not free to do this, and it is not worth my time right now, to be honest with you. So I do it because I love it. I probably won't stop, even if I can't make enough money to justify it, but it would be a lot easier to do it every day if I had enough income coming in from the advertising plus Patreon to actually pay me my going rate. Okay. All right. That's all I'm going to say. That's it for now. Hey, it's been great talking to you. Bye now.